A very good evening, everyone. Thank you for joining us during your dinner time. I'm Billy Toh. I'm the Regional Head of Retail Research at CGS International and the Head of Content at ProsperUS. I will be your moderator for today's webinar session with AIMS APAC REIT. Now, today they will be talking to us about their business update, mainly on the first quarter 2025 earnings, which is going to be quite interesting, I believe. I think their revenue shows some increase, but of course, the DPO shows some decline. So there will be quite some questions in terms of what the strategy in the near terms, especially with the US Fed rate cut, right? All right, before I pass the time to the speakers, let me just do a quick introduction on AIMS APAC REIT for those of you not familiar with the REIT. AIMS APAC REIT is an industrial REIT listed on SGX, and it has property, I think 28 properties across both Singapore and Australia. 25 of them are in Singapore, so their exposure in Singapore is the big one, and 3 in Australia. So just gonna introduce the speaker. Now, today we have 2 speakers. Mr. Russell is the CEO of AIMS APAC REIT Management. So he's basically the man behind the strategic direction and investment strategy, as well as the overall business at the REIT. So if you have any questions, feel free to stay until the end of the session and ask the CEO yourself, right? So Mr. Russell has quite a bit of experience, 19 years in fact, in the real estate and investment and asset management and corporate finance in the Asia Pacific region. So he definitely knows what he's talking about. Now with him is the Chief Financial Officer, Ms. Lim Julie. Ms. Lim is the head of the finance team and will assist Russell in terms of finance, taxation, treasury, capital management, and basically finance-related stuff. She is also very experienced with 22 years of experience in the financial and management reporting, auditing, as well as various finance-related work, including treasury and capital management. Now, before I pass the time to them, just one more thing. This is just the standard disclaimer that we have. So basically, this webinar's intention is basically for awareness and education on companies that are listed on SGX. In this webinar, AIMS APAC specifically. So it is not intended to be a recommendation for any specific investment. If you do find that you are interested in investing in the REIT, feel free to consult with your lawyer, your financial advisors to see if it fits into your portfolio. So all right, I'm just going to stop talking and pass the time to Russell. Russell, over to you.
Great. Thanks, Billy. Okay, great. Chen Long, is the slide up? Well, firstly, look, just thank you everybody for joining us tonight. I know it's pretty late in the evening. Hopefully this session is interesting and informative, and please feel free to ask questions at the end. Okay, great. But perhaps just a quick introduction. I think most of you will probably know who AIMS is, but I think just a quick background on the sponsor. So AIMS APAC REIT is sponsored by AIMS Financial Group. AIMS Financial Group was established in Australia in 1991. They are a diversified services company, an investment group. They have presence in both Australia and Asia Pacific. So over the years, AIMS has raised over 4 billion from the capital markets. They've originated over 9 billion in mortgages. Invested over 3 billion in assets, both in Australia and Asia Pacific. And as you can see, over the years, they've also made strategic investments in the Sydney Stock Exchange. They've also took over the MacArthur Cook fund management business, of which AIMS APAC REIT was part of that business and in the past. And they also have previously partnered with AMP Capital, one of Australia's largest superannuation and investment groups. Now, being headquartered in Sydney, Australia, AIMS has deep market knowledge. They've got strong relationships, strategic insights, and also a deep understanding of the real estate landscape, particularly having its roots in the debt markets and mortgages for the last 3 decades. But really, AIMS APAC REIT, or AA REIT, as we like to call it, was really born from a very pivotal moment in 2009. So AIMS did take over and privatize the then MacArthur Cook platform. It was an Australian listed real estate business. Now, MacArthur Cook had 4 listed REITs. The MacArthur Cook Industrial REIT was one of those REITs in that stable of funds. And so AIMS took over that platform, all of which were in distress at that time. And so through the AIMS involvement and sponsorship, the 4 MacArthur Cooks were turned around and stabilized and generated significant returns for investors. But as you can see, when AIMS took over this particular REIT, the market cap was 60 million. So it has grown exponentially by about 16 times to about over $1 billion today. And the total assets has more than quadrupled from $500 million in 2009 to over 2.3 billion today. So really that turnaround story really has accumulated over the years through a series of strategic decisions, as well as the portfolio rejuvenation strategy, which we commenced in 2011. So that started with the redevelopment of 20 Galway, our flagship multi-story ramp-up logistics facility. In 2014, we also was the first Singapore REIT to invest in an Australian asset. So this was the 49% interest in Optus Centre. In 2019, AIMS actually acquired AMP Capital's stake in the manager and took full ownership. And since AIMS took full ownership of the manager, that's when we actually started to grow the portfolio AUM, starting with Board Riders in 2018, 7 Bullen Street in 2020, and what was headquartered in 2021. And because of that growth, AA REIT is now part of several major REIT indices. So really today, as you can see, we are a diversified industrial REIT, really comprising of logistics and warehouse, which make up close to half the portfolio. You've got industrial assets. So for us, that includes advanced manufacturing, food facilities, data centers, life science facilities, medical equipment facilities. So quite a wide array of industries. And of course, business parks and high tech. In high tech, we've only got one property, and that's more R&D, innovation, and production. Now, for our portfolio, we have about 2/3 of our assets in Singapore and 1/3 in Australia. Right. And look, what's really differentiated AIMS compared to some of the other industrial REITs, we've had a very long history of asset enhancements. And for us, this really means adding value to the portfolio. Now, how do we add value? It's really through improving the building specifications of assets. It involves the repositioning of buildings and the presentation in order that you can attract, retain, and really have master and long-term and major corporates take on long-term leases within the portfolio. Now, it's the underlying tenancies who lease the premises. That's really what provides the lease duration and the cash flow quality of those assets, which really sort of provides the overall value creation for the portfolio. So as you can see over the years, we have extended floor plates. We have entered into asset enhancements, which upgraded properties. And in most cases, in actually all cases, led to a lease extension or lease renewal that ranged between 7 to 15 years. Now, if you can see in the last two boxes, we have 2 current asset enhancements in progress. These were the 2 projects we announced as part of our equity fundraising, which we completed last year. Now, the first project is an upgrade of an older industrial property, and we are looking to essentially purpose-built certain components for a long-term master lease. We have entered into a 15-year master lease contract. It's with a global storage and information provider. So that really underpins the overall value creation process, through the upgrading of the asset and entering into a long lease with a very strong covenant. The second asset enhancement is repositioning of an old industrial building. And this is really a progressive upgrade and really just changing the overall look and feel of the facade, the amenities, the foyer and lobbies. And really the intent here is to vacate the older industrial users and really try to secure and attract high-tech users. And so these could be occupiers that are in the production space. They may be in the technology space. But through this particular scheme, we managed to attract a very strong advanced manufacturing tenant. They're effectively doing precision engineering, aerospace, and technology. And they've agreed to lease 1/3 of the building for 10 years. So both cases, the value creation is through the upgrading of the premises and really securing high quality tenants on long-term leases. We've also had a long history of redevelopments. As I mentioned earlier, we started our portfolio rejuvenation strategy back in 2011, starting with 20 Galway. As you can see, we have developed over 2.8 million square feet of quality space. We've done 4 logistics ramp-up facilities and 2 purpose-built facilities for a food distribution and an advanced manufacturing customer. Now, for our ramp-up properties, these properties are very high in demand. In fact, most of these properties have never been vacant, unless there's been some transition movements between tenancies. But that's really sort of supported the I guess, the portfolio resilience that we've achieved today, as well as the strong rental growth that we've also seen across the portfolio. Importantly, we have another 500,000 square feet of additional space in Singapore and about 1.5 million square feet of additional space in Australia of really untapped plot ratio that could be further maximized in due course. And I think just to complement really the portfolio rejuvenation strategy, we've also got a very sort of disciplined acquisition track record. As you can see, we're not a serial acquirer of assets. We're very selective, and it's important to really acquire the right assets that fit the overall portfolio profile and that adds to the portfolio strength and overall resilience. If you look at the properties up front, all those that are highlighted in orange, these are assets we've either converted to a master lease, we've either enhanced, or we have redeveloped. For the case of 7 Bullen, the top right corner, this is the property which we acquired in 2020. At the time, it was a 4-year lease, and we managed to extend that lease for a new 5-year term at the start of this year at a higher rental rate and also with escalations. For our properties in Australia, as you can see, they're all sitting on very large land banks. Boardriders, which we acquired in 2019, sits in about 30,000 square meter land sites. What you don't see in this photo is it fronts essentially Seaview. And on the right of the properties, there's a Stockland shopping centre. And on the left, there are also other retail bulky concepts. Longer term, we see that this is a potential redevelopment site into a multi-storey building. Similarly, for our properties in Sydney, Optus Centre, Macquarie Park, and Woolworths headquarters at Bella Vista, we are also essentially seen as a longer-term redevelopment play. Both precincts are undergoing significant infrastructure developments. In fact, both precincts have been designated as priority growth zones by the New South Wales government. So that really essentially provides future redevelopment into multi-storey commercial and residential sites within this precinct. Now, these properties have long-term leases. Boardriders, Optus, Boardriders and Woolworths have a balanced 7-year lease. Optus has a balanced 9-year lease. But what we do like is the underlying land value will continue to grow as the infrastructure is developed in this precinct. So really, over the last 3 years, you can see we've had a very strong operating performance. Net property income has grown by over 18% and 6% on a year-on-year basis. Now, this is supported by strong rental reversions, 18% in FY23 and 24% in FY24. And so it's even, I guess, even much more stronger performance given the fact that we've managed to maintain occupancy between that 97 to 98% levels. Again, a very strong result considering that we churn around 20% of our portfolio every year. And also importantly, managing to increase our portfolio well to over 5 years. So really outperforming our industrial REIT peers, really over the past 2 to 3 years. Now, on a long-term basis, since the sponsor took over from FY 2010 to FY 24, you can see that AA REIT has delivered superior long-term total returns of 316%, and are really outperforming the FTSE REIT index and STI over the same period. And I think if you look at where, in terms of yield returns, AA REIT does provide a very healthy yield of 7.5%, which provides a nice healthy spread of between 1.9 to 4.3% compared to alternative yield products. And moving on to our latest quarterly results, I think earlier I did talk about the last 3 years, but really for the first quarter, we also reported strong growth. NPI also rose by about 6% over the last quarter. Now distributions increased by 7%. DPU did fall, however, by about 1.7%, and that was mainly due to the enlarged unit holder base following the 100 million equity fundraising, which we completed last year. Now, that being said, we've had a very strong, robust operating performance. As I mentioned, occupancy is maintained at about 97% levels, but we've also managed to maintain a very healthy double-digit rental reversion of over 12% for Q1 of the current financial year. At the balance sheet level, we are very well capitalized. Gearing is now at a very modest level of 33%. And we also include hedges, in terms of both income hedges and borrowing hedges by about 74% respectively. Now, for this FY, we have included our sustainability commitments. We are targeting to reduce the scope 2 carbon emissions by 5.5%. We're also committed to increasing our solar energy capacity from 10.8 megawatts to 11.2 megawatts, and also introducing green leases, and so looking to incorporate particular clauses within the lease contracts to really encourage our tenants to work with us to really sort of implement energy efficient fittings, and also to help us work towards reducing energy, water, and waste management consumption. Pass it over to Julie to talk you through the financials.
Hi everyone, thanks Russell. I'll just take you through our financials. In front of you, you will see a snapshot of our balance sheet and key financial indicators. AA REIT financial year end is 31st March every year. Therefore, our first Q is 30th June 2024. So as of 30th June 2024, we recorded total asset about 2.3 billion, a net asset of 1.4 billion, and net asset value per unit of $1.31. Like what Russell mentioned earlier, we got very strong and healthy balance sheet. Our aggregate leverage stands at about 33.1%. Our debt funding cost is about 4.3%. Our interest cover ratio is above 4 times, and our fixed debt ratio is about 74 for Q1. Okay, this fresh is a very refreshed slides compared to our Q1 slides. Why I say this is because recently, 2 weeks ago, AA REIT announced that they have obtained a new unsecured sustainability-linked loan, SLL in short, and that SLL has aligned our financing structure to our sustainability goals and targets. And because of our resilient operational results and also strong balance sheet, AA REIT is able to get a very tight and competitive funding structure for this SLL. And on top of that, it has also lengthened the debt maturity tower and also stacked with staggered maturity. We expect the debt maturity to be over 3 years as of 30th June. And upon refinancing, the whole portfolio will be above 50% on an unsecured basis. So if you look into the debt maturity tower on an illustrative basis, you can see that the debt maturity tower will be lengthened into FY 2029 and FY 2030. On the far left, you can see FY 2025, that relates to 100 million bond that will mature in next month. At this moment, we have various capital management options. We continue to monitor the bond market. If the bond market is not favorable to us, then we still have the financial flexibility arising from this new SLL that can be used to refinance this 100 million. Now, upon refinancing, assuming the refinance all, including the bond, then the AA REIT will not have any refinancing requirement until FY 2027. Okay, we move on. Russell, back to you.
Great. So look, as you can see, we have a pretty well-balanced portfolio. As I mentioned earlier, I think logistics and warehouse represent about 47% of our portfolio by value. Now that has actually increased over the year because we've seen that very strong growth within that segment. And if you look at the actual structure, our high-tech properties and our business park properties, they represent about a third of the portfolio, and they are essentially leased to Illumina, our global life science tenant, Optus Center, Optus, and also Woolworths. These 3 properties are essentially master tenanted, and they balance lease terms of between 7 to 9 years, and all with annual escalations ranging from 2.5% to 3%. So really, a third of our portfolio is anchored by these large customers, very high quality, and most of our mark-to-market and most of our leases take place in our logistics and warehouse segment. So this particular segment are typically multi-tenanted. Now you see usually shorter leases for logistics operators because the underlying contracts with the actual customers are also typically 3 to 5 years. So we do have that nice balance between longer term leases to strong corporates. Single tenant is about 42%, and a balance of 48% to multi-tenancies to allow us to really mark to market and really in this current environment, really benefit from that strong positive rental reversions. Now, from a portfolio occupancy perspective, as I mentioned earlier, we've been pretty consistent at between 97 to 98% over the past 3 years. As I mentioned, that's a very good result because we have essentially a fifth of your portfolio just being expiring and renewing every year. And so being able to maintain that level of occupancy whilst driving rental reversion growth, whilst also extending our portfolio well, I think that's really a reflection of the quality of the assets and also the experience of the team in terms of tenant engagement and management to drive these outcomes. Now, on the leasing front, in the last quarter, we signed 16 leases. With that report, as you can see, very strong rental reversions from the logistics and warehouse segment, over 26%. Again, a very strong result. And overall, I think our industrial segment was up 7%. So therefore, averaging about 12% for the quarter. So if you look ahead, most of that dark purple bar for the balance of this year is predominantly logistics and warehouse. I think more than 90%. So that's really going to position as well in terms of sort of ongoing rental growth, as most of that growth has been coming from that particular segment. Now, looking at really the tenant roster, as you can see, we've got essentially leading global, national, and regional corporates that really sort of underpin the portfolio in terms of cash flow. And if you look at the industries that they operate in, more than 80% we classify as essential defensive industries. So these are industries that would have to operate whether there's a pandemic or whether there's a recession. Industries in food and consumer staples, data centers, telecommunications, life science and healthcare, very resilient. So that's essentially the type of profile group of customers that we're looking to partner and work with. Great. So look, really on sustainability, we have reaffirmed our commitments for FY25. There are a couple of major projects that we're currently working on. Really for us, we're working through phase 2 of our solar panel rooftop installation. We think that this will have a meaningful impact in terms of driving solar energy capacity, which will in turn reduce scope 2 carbon emissions. Now, as part of our efforts, I think Julia mentioned, we did announce our new sustainability loan. So this is really aligning both the financing and our sustainability targets, which is a great win-win for both the environment and for unit holders, because once we achieve these targets, it's going to have an improvement in borrowing bank margins and over borrowing costs, which will hopefully lead to higher distributions. So really the purpose of ESG for us is not just certifications. It's really about how do we spend money in the right initiatives to really future-proof our portfolio, so that we can create long-term value for all stakeholders. And as I mentioned, that value creation, it will come from lower costs, lower utility costs, lower bank margin costs. It will come from incremental revenue from the sale of solar energy to the grid. It will also allow us to access new tenant pools, particularly those that have higher ESG requirements. And just a case in point, our first AEI project that we mentioned, 7 Clementi, that tenant really wants us to work towards a Green Mark Gold Plus certification. So that's something that we're thinking about, that will have certain energy efficient equipment and fittings. That's also going to have a potential solar panel rooftop to support that initiative as well. So look, as we look ahead in Singapore, I think we're very well positioned. Really, the Singapore economy has continued to grow quarter on quarter. Both its PMI and its manufacturing output has also grown, and I think at its highest levels over the past 3 years. And so what we've seen is the economic data supporting really ongoing investment commitments by major global players across various industries. Recently, there was news of Pfizer investing close to $1 billion, and Collins Aerospace $250 million on new state-of-the-art automated manufacturing facilities. So that's really going to create downstream demand from players within that ecosystem. And of course, downstream demand for warehousing space, because once goods are actually prepared and manufactured, they need warehousing space to facilitate movement within Singapore and also outside of Singapore. In Australia, our 3 master lease properties are also all located within precincts that we see are undergoing significant infrastructure investments, particularly, as I mentioned earlier, our properties in Macquarie Park in Bella Vista is undergoing transformation in terms of new multi-story development projects. And of course, in Brisbane, where Burleigh Heads is located, Burleigh Heads, Port Riders, there is the Summer Olympics that is being slated in 2032. That's going to drive new investments and new infrastructure within the Queensland region. So that's really going to all leading to underlying growth in land values in those precincts. So really, to conclude, our focus is essentially focus on these 4 strategic pillars. It's really selecting the right assets to add to the portfolio. We like to say we like to build the portfolio asset by asset. So we're always looking for strong foundational properties to add to the portfolio resiliency. Active asset management is really focusing on proactive tenant engagement and partnerships. It's really looking at redevelopments and asset enhancements to continue to enhance and improve the property specifications. It's also important to really manage the balance sheet very well and have a strong and prudent capital management strategy. That includes, managing your hedges. That includes, looking at also capital recycling to manage your overall cash flow. And I think importantly for us, we will be looking at partnerships to actually help us grow. We think that will help us diversify risk by really sort of partnering with other strategic long-term players. So really, just to conclude, AA REIT, we are well positioned for growth, and we have a very strong balance sheet that gives us the flexibility to pursue new acquisitions as well as to fund our upcoming asset enhancement initiatives. Thank you.
Thank you, Russell and Ms. Lim. Thank you for your presentation. All right, just to remark, I think we've actually wrote about AIM's APAC, I think October last year as well, that talk about us investors to actually ignore the noise surrounding REITs and just invest in the long term for the yield and for the resiliency. And I think as seen by the share price in recent times, it's probably justified if you've been holding on to the company. Anyway, let's go into our first question. I think there's one here that's talking about your dividend. I think you guys have maintained a steady distribution growth over time. Do you expect this to continue in the current interest rate environment, or are there headwinds that investors should take note of?
Look, I think we don't typically provide, I guess, dividend DPU forecasts. What I can say from an operational performance, we're sort of firing on all cylinders, right? We've got really, if you look at the bulk of the expiries, it's going to be in that logistics segment, which will continue to see that good demand and the good reversions in that particular segment. We're focused very much on our 2 asset enhancement assets that will hopefully drive incremental value. At the moment, they're both projected to see an increase in net property income by over 7%. But in fact, I think the first project, we're trying to sort of work closer towards 8% yield on completion once the actual project's completed. So that's going to help us again, see incremental growth with a very healthy headroom. We are pursuing and assessing opportunities in our core markets of Singapore and Australia. We like both markets because we think there are still very resilient growth drivers. So I think if I look at where we are, I'm fairly confident that from operating top line performance, it's going to be definitely a positive year for us.
Okay, thank you, Russell. I think you mentioned you focus on your core markets, and there's a question on this that I think you have a strong presence in both Singapore and Australia. But do you have any plans to actually diversify outside of these 2 countries, given the global market conditions and opportunities that you're looking at?
Look, I think for us, we're very much focused on these markets because essentially we've got boots on the ground, we've got track record, and we've got expertise in these markets. We see enough opportunities both in Singapore and Australia. We think both markets actually complement each other. Singapore is typically higher yielding, very stable sort of leasing market because the JDC properties are administered through the agency. So you don't see a lot of speculation. And really, if you look at the profile of tenants, these are investment grade, very high quality covenants. So the cash flow quality is very strong. Australia, on the other hand, you've got it's freehold properties, typically lower yields. But what we find is, because you've got freehold land, you've got a longer term capital appreciation potential. Australia has also much higher sort of embedded rental escalations. So you might get a slightly lower yield from day one, but that rental rate will grow much faster compared to Singapore. So it does provide that complementary benefit. I don't think at this stage we are looking at new markets.
Okay. No. That's good to know. And just wondering, I think you talk about ESG as well, right? I think sustainability was very much part of your presentation. So there is a question on that. Is that the ESG installations that some of these initiatives do come at a cost, right? Will this translate into higher rent rate for you guys, or how does it work?
Okay, look, that's a great question. For us, we enter into a partnership with the solar panel provider. So there's actually no upfront costs to the REIT. This is we essentially pay that provider a fixed rate over a period of time. So there isn't a capex outlay. It's essentially a fixed tariff that is paid to them based on the generation of solar energy.
Okay. And just wanted to know, in terms of your asset enhancement project, I think the one at 7 Clementi Loop and the Tai Seng Drive, right? When will this translate into meaningful in terms of on your financials? When will we see that? Or is it
okay? Our first project, there will be some downtime because we're essentially going to vacate the tenants and really upspec the property for the master tenant. So that would probably take about 9 months. So we are hoping for the works to be completed. I would say probably by Q1 of next year, which is going to be, I guess, Q2, the sort of Q2 period. So that's really the timing that we're hoping to have all the works completed for the new master tenant to come through. The second property is it's going to be refurbished progressively, floor by floor. So there's not going to be that big downtime impact compared to the first project. But in terms of the rental reversion, we essentially have to complete the works and essentially then sort of enter into higher rental rates once the leases expire. So that will be a slow take up over the next 12, 18 months once all the actual tenants move out and we have new tenants coming in, hopefully paying a much higher rent.
Will this affect the portfolio occupancy rate during this time? Just because at this point it's at 97.3%, right? So
yes, so I think during that transition period, I think with 7 Clementi, that occupancy may drop slightly over that period of time.
Okay. All right, there's another question on your cost of debt. I think the audience find that it's on the high side. Do you see the cost coming down significantly in the short term? Do enlighten us if it is not on the high side, right? To correct us if it is not.
Hopefully it will come down. Okay, so we do see US Fed has started in monetary easing policy. That's good news for the REIT and industry as a whole. We hopefully will see another 50 bips on the table and another 100 bip next year. Now, if this does happen, then the immediate beneficiary will be on our floating debt portion, right? Currently, we are about 26% is about floating. So you can see that immediate impact on the floating rate portion. Now, if this do happen, we will see some easing in the blended interest rate costs. Having said that, I must also say that our average fixed debt tenure is about 1.5 years. So what that means to me is in another 1 and 1.5 years to come, I will need to replace my fixed debt ratio. If the interest rate cut as per what the market predicts, maybe another 50 bips and 100 bips next year. If it happens fast enough, then we will see some easing in the pressure of the blended interest rate cost. If not, then I think that would remain elevated for some time. As we speak currently, we do see that monetary easing policy has happened. Having said that, there's also rising tension in the Middle East that has caused a little bit of a knee-jerk reaction in the market as well. Crude oil prices has increased, inflation may be exacerbated. So we do see some uncertainty in that area as well. As much as we want to see costs coming down, we want to also remain cautious and practice very prudent capital management policies.
Okay. And since your gearing level is only at 30+%, which is relatively, I think, comfort level, is there any plans for as acquisition or anything that you guys are looking into?
Yes, and look, I think as I mentioned earlier, we haven't been a serial acquirer of assets, but we continuously assess the market for opportunities. So certainly, as I mentioned, we like the drivers and the resiliency of both the industrial market in Australia and Singapore. Singapore, we are still seeing continued investment, fixed asset investments by these corporates, again across multiple industries, advanced manufacturing, life science, aerospace type industries, electronics as an example. So this is really underpinning the demand for those type of assets. Now Singapore, every deal I see in Singapore, maybe see 5 to 10 in Australia. Singapore is a much smaller market. We like Australia because one, they've got obviously net migration growth, which has led to obviously increased consumption, but they're also a pretty large infrastructure-led country, and that also leads to really strong underlying industrial demand in terms of both industrial facilities and office space. So if I look at the two markets, I like again good quality logistics and industrial. Australia, I like also the same segments, though the yields tend to be a bit tighter because they are very high in demand. But Australian business parks are also looking interesting, but you've got to be quite discerning. You need to look at the actual sub-market itself and the location. And obviously, from our perspective, we're always looking for not only the asset type, but we're also looking for that longer-term redevelopment enhancement potential. So essentially, these are the assets that we are evaluating. Again, in a declining interest rate environment, I think we are looking a bit more positive in terms of acquisition this year.
Okay. And just wondering, the key sectors that you will be focusing on within your tenant base, do you have any that you can share with us, and how they will actually contribute to the portfolio stability? Not sure if it.
Look, as I mentioned, I guess logistics is more straightforward, but industrial, you're covering advanced manufacturing, life science, data centers, aerospace, electronics. So there's a lot more varied in that regard. What's important for us is actually the underlying covenant of the tenants, right? Because the tenant covenant underpins the cash flow quality, and therefore the overall value and also the distribution profile. So I would say we're generally more agnostic on the actual industry itself. Of course, we're seeing more demand for tenants across the emerging industries like life science, data centers, advanced manufacturing, but really the underlying covenant. So that's a focus for us for any acquisitions.
Since you mentioned data center and it's quite hot these days, is there any plans to add this into your portfolio to be standalone?
Look, we have one data center, and that data center was an old industrial building. That tenant grew into that building, and so they've now sort of taken on that property as a whole. Unfortunately, we haven't been able to uncover any other data center projects. We were looking at a conversion, probably 2 or 3 years back before the moratorium that was set by the government. But certainly it's an area that we like, but from a yield and a price risk adjustment perspective, I think it's still fairly expensive. But certainly there's an opportunity for us to work and partner with the data center operator. It will be a segment that we will explore.
Okay, I think you talk about your sustainability goals just now, as well as the financing that is linked to these goals. I think there's the targets for 2025 and 2030.
Yes.
Yeah.
So our longer term target, ultimately, we are targeting to a 42% scope 2 carbon reduction from 2020 to 2030. So that's the overarching long-term commitment. And that commitment also follows the SBTI, the Science-Based Initiative measurement, also in line with the broader Paris Agreement. So I think the targets that we gave for FY25, we're trying to break down those targets every year, so that every year we try to sort of make a meaningful impact on a year-on-year basis.
Yeah, but your sustainability linked loan, those targets are for the 2025 and 2030, right? Or is it?
Okay, so every year that target, we've got to refresh those targets. So it's for example, it's a 5-year tenor. So the targets which we've announced, that will be agreed and reviewed every year.
So if you hit the target for the year, there will be your cost will be lower. Is that correct?
That's right.
Or is it at the end of the 5 years? Or say yearly?
Every year, every year.
Okay. So just wondering, what are some of the strategies that you have in mind to meet these targets? Will that lead to an increase in cost? No, right, I'm guessing.
Okay, so okay, I think if you look at our initiative, we try to be strategic in terms of how we look at the various projects. Most of the major equipment that leads to I guess high energy consumption and therefore high carbon emissions, these are typically your large M&E items like your HVACs, your chiller systems. So we try to time some of these replacement works at the end of its useful life cycle, right? Because you don't want to put everything in one year. You try to work out if a chiller is maybe past its useful life and it's due for a replacement. We try to sort of look at it and time it each year, because it is a large cost. But every time we look at replacing such items, we're also looking at the payback. So how much does that reduce our operating costs by having such an equipment in place? And so that could also not only be the large equipment, but it could also be rolling out, for example, energy efficient LED lightings across the portfolio. So this could be within the premises, this could be within the loading bay areas. So there's actually a lot of little projects that collectively will make the difference. So every year we'll try to have at least 1 or 2 projects at each of our properties. But I think that the major one that we are working on that will have a pretty meaningful impact will be the phase 2 of our solar project. So that will cover up to another 5 or 6 buildings. Actually, phase 1, just to put things in context, was about 10.8 megawatts. Phase 2 will be probably another 50% of phase 1, so maybe another 5 megawatts. So quite substantial, but we need to roll this out over the next 1 or 2 years because some of this also involves working with our master tenants and sort of taking back access to the rooftops in order to implement those works.
Okay.
Billy, maybe I just add on what Russell mentioned, phase 2 solar panel installation and also phase 1. These all don't have capital commitment. These are all PPA model. There's no additional cost to the REIT. What benefits the REIT is the solar that we generate that creates additional income to the REIT. The third goal is on a green leases. That is also an education process. It doesn't have any capital outlay as well. It's an education process between the landlord and the tenant to encourage all these green initiatives. So overall, that 3 targets that will not cost us a lot of money.
Okay, all right. And I think there's a question on the interest rates. I think since the interest rate is expected to come down, do you see yourself increasing your exposure to floating rate instead of fixed rate? Or what is the strategy?
I think for a REIT as a whole, we want to remain prudent. We want to practice very disciplined capital management. No one will be very sure, right? Now you say it's a declining interest rate environment, as I mentioned earlier. Although we hope to see 50 bips more on the table by the end of this year, 100 bips next year, we may not know what will happen, right? The Middle East tension may cause another problem to us. So we, as a REIT, we want to maintain a very prudent policy and also manage our risks to give a balance to the DPU. So what I'm saying is I will not go lower, very low in terms of leaving the REIT exposed to the floating interest rate debt. So we want to maintain a very balanced policy and give a balance to the DPU.
Okay. I actually noted that I think back in 2022, the gearing ratio is at 37%, and it came down to 32.9%, and now I think remain relatively stable at this level. Do you guys reduce your gearing level because of the high interest rate environment, or was that just so happen?
No, I think at the time, the decision to reduce our gearing, this is a time when I think the credit markets were quite uncertain. If you can recall, there were the 2 US banks that essentially defaulted. There was the takeover of Credit Suisse by UBS. So from our perspective, we also weren't sure what was happening to the credit markets. So I think we took the decision at the time to raise the capital, not only to bolster the balance sheet, but we had the 2 asset enhancements that we knew that was coming up the stream. And I think our perspective was, I think, reduce the gearing because if the markets got worse, that could essentially affect borrowing costs. That could affect also valuations if interest rates start to spike up because of all this contagion. So we weren't quite sure what was going on. So we took that preemptive approach, but we knew we had some asset enhancements that were coming up the stream that was going to give us very good returns. So it's basically trying to kill two birds with one stone, have funding in place to then fund the AI growth sustainably and responsibly, but also have a reduced gearing to give us the buffer and headroom in case there's any potential shocks that may come to the system. So it's really trying to manage it on two sides, and also having that potential headroom, because if really the markets got worse, we'll then be in a position to potentially opportunistically acquire assets at heavy discounts, right? Because normally when you want to acquire assets at a very discounted rate, the debt markets may not be open, equity markets may not be open, and that's when the best opportunities to acquire. As I mentioned very early on, because of I guess our sponsors' roots and history in mortgage lending, and sensitivity to interest rates, that was something that was a position that we took, just in the mindset of just preempting what may happen given all the credit market issues in the US and in Europe.
Okay. Actually, the reason I'm asking is because I think at this level, 33% is probably lower than most of the industry average, I guess, right? So is there any intentions to increase that level, or are you guys comfortable at this level until you see something that you're interested in the market?
Look, from our perspective, look, I think we're comfortable at this level. Now, that being said, with that headroom, clearly there's that room to go and pursue, good quality acquisitions. So we haven't been doing anything since 2021. I think within the current environment with rates declining, I would say acquisitions remain a very good opportunity for us, and potentially seeing, using that headroom accordingly.
Yeah, because I felt that there should be some room for you guys to look into this, right? I just wanted to ask, is there any other asset enhancement that you guys we can be looking forward to, or that's it for now, just the two?
Look, if you look at our background, we typically do either an asset enhancement or redevelopment every 1.5 years, generally. This is probably the first time we're doing two asset enhancements in one shot. So I think from our perspective, it's, we are very much focused on just executing on this over the next financial year. We are assessing our portfolio, and we do so every year. There is a potential redevelopment of an industrial asset that we are looking into. This property sits in a JDC industrial food zone. It's a master tenant, and we're looking at different options to optimize that land. So at the moment, the plot ratio is half the maximum available plot ratio. So that's something that we are looking and just exploring and just looking at the overall concept. Clearly for us, before we embark on any AI or redevelopment, we're looking at that pathway for value add. So we're just running through the exercise now. So that may be something that will come over the next, maybe 1 or 2 financial years.
Okay, I've seen share prices has gone up quite a bit after the especially with the anticipation of the rate cut. Just wondering, what are some of the key risks that you guys are looking into? I mean, especially with US, I think they're talking about soft landing and stuff like that. Is there concern, especially when you talk to your tenants, is there concern that there might be recession or slowdown that is sharper than expected? What are some of the key risks that investors should really pay attention to, especially if they invest in AIMS, right?
Look, I think for us, historically, most of the risk has been externally driven, whether it's interest rates, whether it's inflationary costs. From our overall execution perspective, we're very much just, leasing, asset enhancements, prudent capital management. That's the bread and butter. So we're always looking at I guess, growing the portfolio in a defensive manner. I guess with declining interest rates, I think that's something going to be helpful in terms of lowering financing costs and also having that useful acquisition yield spread, where it is accretive. But whether that is also offset by potentially slowing economic movements, or there's any, as I think Julie mentioned, any of the war, if the Middle East war or the Russian war actually gets worse, that could have a flow-on effect. Geopolitical risks, increased US tariffs, and potentially slowdown in China, exports, imports, and just general trade, global trade, that could have an impact in terms of capital investment in Singapore. Because as I mentioned, the Singapore industrial market is really sort of driven by the underlying investments by these global companies, be it US, be it Chinese companies, that use Singapore as the Southeast Asia hub, right? Where they set up all this innovation factories and companies for the businesses. So there's going to be that slowdown and the protected a bit more of an insular view that may have an impact indirectly on the market. But generally, from our perspective, as I mentioned, most of our tenants are in a fairly defensive, essential industries. So I think we're fairly well positioned to hopefully ride out any market volatility.
Okay, I just have one last question. So I think Singapore is known for the REIT market. Just wondering with this, how do you guys stand out among the rest of the REITs? Like, you know, why do you want to go for
For AIMS?
Yeah.
No, I think as I mentioned earlier, if you look at our history, we've always been very prudent, very careful. When it comes to asset selection, we don't just buy assets every year, because at the end of the day, property is a cyclical market. You've got to time the entry of timing. And so we're always very careful with what we call foundational assets. So these are assets that will fit into the portfolio that creates that resilience. But we're always thinking about, can this asset in the future be redeveloped or enhanced to create more value, right? So I think that's really been one of our key focuses. Then you overlay that with our long history of asset enhancements, redevelopments, doing one every 1.5 years, particularly in periods when it's not the right time to do acquisitions. So we're always trying to manage the top line growth through manufacturing that capital and income growth. And as you can see on the capital management side, we're also fairly careful in terms of overall gearing. So yes, our gearing is at 32-33%. That gives us the flexibility and the headroom, as well as the buffer to withstand any market shocks. And as part of our broader strategy, we're now looking to expand our growth strategy to include capital partnerships. So as we look to grow our portfolio, we want to grow responsibly and also to partner with like-minded institutional investors, so we can diversify our risks as we invest into more assets.
Okay, all right. Thank you, Russell. I think for our audience who are listening in, so you've seen AIMS APAC REIT have reported strong financial growth. I think revenue grew by about 9.7%, net property income at 6.6, with rental reversion at double digits. So that's quite resilient, with a resilient portfolio occupancy. So if you have any other further questions, feel free to just send it to us. We will try to reach out to both Russell and Ms. Lim if there are any questions. All right. Thank you for joining us for today. Hope you guys have a good night. Thanks, guys.
Great. Thanks, Billy. Thanks, everyone.